Okay, guys, look. I mean, we already waited a minute and a half. Okay, that was enough. Maybe not. Yes. Now, we have a very challenging topic today. It's a very important topic in this introduction to AS, this application of machine learning techniques to accounting and auditing. I selected two very interesting papers published almost at the same time. I mean, there is a year difference in publication. Neither one had a particularly easy going if you look at the original submission dates. So it took years for each one to make it. What is interesting, they're kind of complementary. They're, on the one hand, they're on exactly the same topic. On the other hand, that you'll see that they're doing actually quite different things, and this is what makes it particularly interesting. So what makes this whole business very challenging is your assumed lack of methodological preparedness. So to be able to truly appreciate what people do in these papers, you really have to have some background in this area. And I assume that most of you don't. I don't know if all of you will get this background. Some of you definitely will, because about half of this class is undergraduate AIS majors. And those of you, a year from now, will have the pleasure or displeasure, hopefully, of having me teach you machine learning. Okay? So the other half, I assume, probably will never encounter this, which is a pity, because it's a very important methodology. Unfortunately, it doesn't show up that often in the pure accounting research, even though one may argue that this is really the ultimate test. So the first paper is this financial statement fraud detection, analysis of statistical and machine learning algorithms. By the way, this statistical and machine learning, it's kind of, a historic tradition, because conceptually there is really no difference between those algorithms. There are some differences in the assumptions under which those algorithms are developed, but if you look closely at the applications, that you'll see that there is not that much of a difference. It was published in the Auditing Journal, and therefore has more this auditing focus, but there is really not that much of a difference. Now, both papers start with this discussion of fraud and how important fraud is. If you read those two papers very carefully, that you'll probably find it quite curious that even though that the first paper is published in the Auditing Journal, and it does go into this discussion of the history of auditors' attention to fraud, somehow it manages not to mention SAS 99, that the second paper does mention. Okay, SAS 99 was probably the last hooray of the Auditing Standards Board. It became effective in late 2002. That was about the time when the Auditing Standards Board was losing its power to set the standards for the audit of the SEC filers. The Auditing Standards Board for a long time had that power, so they issued about 100 statements of auditing standards that governed how audit was done. And then, a number of audit fiascos struck. Sarbanes-Oxley passed, right? And as a part of that, one of the major changes that was introduced, that actually creating a separate body, Public Companies Accounting Oversight Board, PCAOB, which actually got that power. So they became the standard setter for the audits of the SEC filers. As one of their first acts, they actually grandfathered all the SASs up to that moment when they took over. And I think that the last one was 101. So actually, if I may be wrong, but it's about that time. So SAS 99 was about one of the very last SASs which was grandfathered and became a part of this. So why was it so important? Well, because fraud was always a very awkward thing for the auditors to deal with, particularly the kind of fraud which is addressed in these two papers. So both papers are dealing with the financial statements fraud, okay? So basically, significant misrepresentations, intentional misrepresentations on the financial statements. So this kind of fraud is typically perpetrated by the managers, right? There is another kind of fraud, which is typically perpetrated by the low-rank employees, right? Like, stealing assets, that kind of stuff. So that fraud is no problem. I mean, auditors can deal with that very comfortably. Management fraud is a really awkward thing because the managers hire the auditors. Well, we say that it's really the board of directors through the audit committee. By the way, that was established really clearly by the Sarbanes-Oxley. And the auditors don't really have that much power. That may surprise you, but so what would happen to a manager if the manager lies to the auditor? So what happens to the manager if the manager lies to the auditor? Yes? Well, if they discover it, they probably will bring it up with the committee. What happens if the manager lies to the FBI agents? They go to jail, right? So you know that lying to a law enforcement officer is a felony. Lying to an auditor is not a crime. Not only it's not a felony, it's not even a misdemeanor, as far as I know. Okay? So the auditors have this awkward position that they're supposed to uncover this management fraud. At the same time, they really don't have that much power over the managers, right? So for that reason, the auditors always claimed in the beginning that it was not their job, that they were not really called in to discover that management fraud. And each time when that fraud came up, the auditors were sued. They tried to argue their case in the court of law, explaining that they're not really that well positioned to deal with this. And each time they lost, pretty much. So people were talking about the so-called expectation gap. So what the audit was designed to do and what the public was expecting from the auditors. So it's been a very long back and forth. Yes? Of course, because there is this reputation cost, right? Yes, and we'll talk. You'll see the cost function here. Yes, of course. So the auditor doesn't want to deal with fraud. So fraud is a problem. So if any fraud comes up, it's a big problem for the auditor. This is one of the reasons that, say, when a partner brings in a new engagement, which is money, right? The audit firm doesn't just rush in. So there is this due diligence, which is done. So there is this risk evaluation practice. They just see what that engagement is and how likely it can become problematic. So there are cases where public accounting firms will just turn down a new engagement simply because they consider it to be too risky and things may happen. So it's not worth their while. Okay? So yeah, but the point is that you see, fraud is, particularly management fraud, is a very tricky thing because you're dealing with very smart people, right? Who will try to cover their tracks, right? So people keep talking about Sarbanes-Oxley, right? And they keep bringing up Enron. This is what you keep hearing, right? So what was that fraud in Enron? Was there fraud in Enron? Well, I mean, yes, there was. Do you think it would be easy to nail Enron in the court of law based on that fraud? Do you know what the accounting issue was in the case of Enron? That what was that fraud? Yeah. Well, they use the so-called special purpose entities, SPEs, to shift liabilities off their balance sheet. Yeah, but actually it was not illegal. So what was illegal, that there was an arcane rule that they were supposed to have a sufficient skin in the game, as they said. So they were supposed to maintain an interest in those special purpose entities in the amount of about 3%. Now that ruling actually was a very low level gap. It was in the papers of the so-called Emerging Issues Task Force. It was not even a part of the Statement of Financial Accounting Standards. Okay, so it was a considered gap, but you know, there are categories of gap. And they violated that a little bit. So there was a technical violation, so yes, but it would be very difficult to nail them. So they were nailed on covering up. And even that actually, you know, that decision was overturned. I don't know if you have heard, it happened a couple of years ago. That actually, so when the government went after Enron and prohibited them from doing audits because of this, you know, covering up, destroying working papers and all that stuff, so there were certain procedural violations. So that decision was overturned on procedure, I don't know, 8 years after, or maybe 12 years after Enron went belly up. Okay, so I mean, of historical. So this is a difficult problem, okay, no doubt. Everybody agrees that this is a very expensive issue. So there are some estimates. So there is this estimates of 572 billion per year. So this is from this paper. Now, when you look at those estimates, keep in mind nobody knows for sure. And usually the bodies that produce those estimates, like you know, the Institute of Fraud Examiners, they have a vested interest to show that this is a big problem, right? Even given all that, it doesn't mean that the problem is not big. Okay, so I don't know if it is $572 billion per year. Maybe it's 571, you know, who knows? That was a joke. Okay. I love when they give those things with 3 significant digits. Just, it's wonderful. Okay, so what are the problems? Well, the good news is that, well, it's the good news for the society, for the economy. The bad news for people who try to study this is that fraud is a rare event. Okay, so it doesn't happen often. So therefore, it's difficult to estimate, you know, that the estimating probabilities of rare events is a very difficult task. Now, what makes it even more difficult, what compounds the problem, is the fact that we know only about that fraud that was uncovered, right? So by definition, we don't know about that fraud that was not uncovered. And one would argue that, of course, it is the most sophisticated fraud which is not uncovered, right? Well, some people would argue that, you know, sooner or later, if you are dealing with a management statement fraud, if you're, since the time keeps going on, sooner or later it will come to the surface, because it cannot continue in perpetuity. So, but still. Anyway, another issue is a highly asymmetric cost of fraud. So what's that? Well, when you are dealing with the issue of identifying fraud, okay, you are dealing with a so-called prediction problem, right? You are trying to predict that something happens or doesn't happen, okay? When you make this prediction, you can commit two different types of errors. You can predict that something happens while in fact it doesn't, okay? And this is called a false positive, okay? So that it's like, you know, like in medicine, positive, probably not a very good word to use here, but you know, God forbid if you get a positive result on a medical test, right? So that's the same kind of positive. So positive here means that we're predicting fraud, okay? And that positive can turn out to be false. And the other case is when you predict that nothing is going to happen, the event will not happen, while in fact it will, okay? This is known as a false negative. So what makes this area particularly difficult, that false negatives are orders of magnitude more problematic than false positives, okay? Why? Well, what's the problem with the false positive in this case? By the way, that's exactly the same as in the medical domain. From that point of view, it's no different. So this asymmetric cost of false positives and false negatives. Yes? Yeah, okay, so it costs some money. A lot of money? Well, I mean, in the grand scheme of things, not that much, right? So what's the cost of false negative? Well, you don't really know. Possible ruin, right? It's like with a medical test. Okay, it was a false positive. So what happens? The doctor will order more tests. Okay, good for the labs, but that's... So they run more tests. Hopefully they confirm a false alarm. No harm done, right? Some money wasted, but I mean, we can live with it, right? So given the choice, we would all rather live with that, right? And so what happens with a false negative? Well, I mean, yes, potentially catastrophic result. This complicates the issue. Why? Well, because we have to take it into account when we evaluate the performance of our prediction algorithms, okay? So when we are making predictions, you know, everybody is a prognosticator. So how do people rate predictions? They rate it at the frequency they come true, right? So how accurate they are. So that's a naive approach, because in this approach, you basically, you add up the frequencies of false positives and the false negatives, right? In a sense, when you do this. And it's not appropriate here because of this issue, right? Yeah? That's another issue. By the way, this paper doesn't really talk about this. It is. The second paper actually does. So if you read the second paper carefully, there are remarks at the end of that paper that are talking about the fact that, you know what, this is really an evolving thing, and we should be doing something that addresses this thing that is evolving. Sorry. But you're right, Denise, yes. It evolves. You're right. It happens with many patterns, right? You catch a pattern, it starts evolving over time. The only difference here is that, you know, you're dealing with a very smart adversary, so it may be a self-fulfilling prophecy. So you start watching for certain things, right? You invent a great mousetrap, right? And all of a sudden, your mice start getting smarter. Right. So that's a problem. Now, the other two issues that they bring up here, the attributes. Well, what is indicative of fraud? Well, who knows? I mean, many different things. If you read the paper, I hope you did, you saw long lists of attributes in each one of them. What was interesting about those lists of attributes was that the symmetric difference was rather significant. Right? You know what the symmetric difference of the two sets is. The things which are in one and not in the other. Right? Which is interesting, because both papers try to do a very good job. So the attributes, there is no attribute which is clearly indicative of fraud. So the same values of the same attributes in different situations may mean absolutely different things. So it's really a combination of different attributes and combination of their values, and they're all very, very noisy. So we are not really sure what the proper values of the attributes are. So it's a big problem, right? And as I said, so the problem is that you have this active resistance. You're dealing with those adversaries, right? So this is the problem. Okay, so what does the first paper do about this? Well, it tries to answer 3 research questions. Okay? So how do we create algorithms that would allow us to predict fraud? Now, this prediction business is not often done in accounting. So if you look at the papers which are published in empirical accounting research, that you will mostly see the papers that are trying not to predict, but to explain. Okay? So they say, okay, we have this data set. We have this theory about what it may mean. And then they say, well, our theory predicts, and that's often the case, that certain coefficients will have a certain sign. Well, that's I would say that this is, in my opinion, that's too much to claim this is a prediction. Because if your theory doesn't really allow you to say something about future events, you're predicting that in your model certain things will behave a certain way. In my book, it's not much of a prediction. Okay? So it's basically, it's a description. You are describing this phenomenon, and you see how this description works. I'm not even mentioning the fact that very often the explanatory power of that prediction is really lousy. You know, when you're talking about, that was one of the shocking experiences. You know, I made the transition to this area from the natural sciences and engineering. And in those areas, when people ran R-squares, the expectation was to get into, linear regression, the expectation was to get the R-squares in the order of magnitude of 60, 70, 80%. Because if that's really a real phenomenon with the linear behavior, this is what it's supposed to look like, even if you have random shocks in the system, right? So when you are around those linear regressions, you get an R-square, say 3%, which is a terrific result, right, in the capital market research. The only thing that comes to your mind is that this is garbage, right, because there are so many omitted variables, and you throw other things in, and everything changes. All the coefficients change, everything changes, right? So you can talk as much as you want about significance. Now, this is the real deal. Now, here you either predict correctly or you don't. So either fraud happens or it doesn't. Either the sun is going to rise tomorrow, right? Or it will not. Well, me too, yes. Okay, so how do we construct those prediction algorithms? So it's a very difficult task, right? What algorithms should we use? Now, this is a huge area that has been researched for years. So how to make predictions, right? I brought up linear regression. This is not really, linear regression is about establishing empirical dependencies between things. Prediction deals with a binary decision problem, right? So prediction is a yes or no. So the analog of linear regression would be logistic regression if you studied that in econometrics, or probe it. Okay, so whether instead of a logistic function you use the cumulative distribution function of the standard normal or something like that. But there are millions of other areas, right? So one of the most celebrated methods of prediction in statistics was Fisher's discriminant analysis, right? Which is by now approaching, it's 80-something years old, right? By now. So there are many other methods, both developed by statisticians and computer scientists. And this is one of the questions that this paper tries to answer. So which of those methods works best in this domain? Okay? So when those of you who will take my course in machine learning, you should encounter the so-called no free lunch theorem, which basically states that there is no universally best prediction method. It doesn't exist. So it's actually, it's an easy statement to make and argue, but it should be clear at the intuitive level. So depending on the circumstances, different methods will work better, because whether they will fit the problem or they don't fit the problem, right? So it's a very good news for the researchers, because it tells you that there is nothing which is universally superior, and for every application, it's your job to find out what works best. And this is what this paper tries to do. Now, but where it tries to do it specifically for this problem at hand, fraud prediction, okay? And so therefore, he tries to pick not only the classification methods to use, but also which variables, which predictors to put in those classification methods. This is what he calls research question number 3. Now, and what is particularly interesting about this problem, he tries to evaluate a particular way of dealing with the imbalance, with the low probability of fraud, okay? And differential costs of false positives and false negatives. By the way, those are kind of like dual issues. I don't have time to go into this issue, but there is a very useful footnote in the first paper, which gives you some argument and some of the necessary pointers to understand that actually that the imbalance of the sample is equivalent to the differential cost of false positives and false negatives. You can translate one into the other. Okay? Why is it important? Well, that this equivalence exists. Well, it is important because some of the prediction algorithms are designed in such a way that they can explicitly take the differential costs of false positives and false negatives into account. So when you use that algorithm and you feed the cost matrix into that algorithm, it will attempt to optimize the decision rule for that cost matrix, okay? And that's great if the algorithm can do it. Unfortunately, many very useful prediction algorithms are not designed that way. So the way they work, the way they construct predictions, doesn't take into account the differential cost structure, okay? So therefore, when we are comparing all those different algorithms, we don't want to restrict ourselves only to those that explicitly take into account that differential costs of false positives and false negatives. So we want to evaluate all of them on the equal footing, and therefore we actually want to reduce the problem, okay, to something that each algorithm can handle. So they use this equivalence, and therefore they talk about the fact that, okay, so we are going to reduce it just to translate the differential cost into the probabilities of fraud, right? Will increase or decrease probabilities of fraud depending on what the costs are. And then every algorithm can be compared, because each one of them will just deal with a different balance of the fraudulent observations in the sample, okay? So which sample? Okay, so here we have to explain this, okay, and before I go there, so let's go there first. So we have to talk about another very important feature of this domain, that how we evaluate what our results in this domain. Now, those of you who are familiar with traditional empirical accounting research, econometrics, say logistic regression and all that stuff, so they know about R-squares and similar things. So those are measures of fit. They are not measures of predictive accuracy, okay? So you have your data, and you have an idea what the proper model of that data is up to the values of the parameters of the model, okay? And then you have to solve an optimization problem. You have to find the best values for the parameters in the model given your data, okay? So it's indeed, whatever algorithm you'll see, you choose, in fact, they are solving an nonlinear optimization problem, okay? It doesn't really matter whether they use the maximum likelihood method or any other method. So what, in fact, they're doing, in all of those cases, they're solving a nonlinear optimization problem and finding the best values for the parameters. So when they find that, they know that for this model, these parameters give the model the best fit, right, to your current data. And you can evaluate that fit. So in the case of linear regression, such an evaluation is the R-square, right, which is the percentage of the explained variance, right? Well, this fit is not particularly useful here. Why? Well, because we can overfit. Okay, that one of the biggest problems in machine learning and in prediction is overfitting, right? You should know about this phenomenon even in linear regression, okay? So if you throw more regressors in your model, in the model of linear regression, you know that your R-square can only improve. It's a mathematical fact. So when people do that, for that reason, they're trying somehow to discount the number of regressors. That's why what people report usually is not the R-square, but the so-called adjusted R-square, right? But even that adjustment doesn't really tell you much, right? So the problem is that you are trying to fit what you are constructing to the data at hand. But what you are really interested in is how your model will behave on the data that you don't have, okay? Because that will really determine whether it can successfully predict or not. Well, by definition, we don't have that data, right? So how can we tell? Well, in machine learning and other prediction literature, what people do, they simulate this prediction by using the so-called cross-validation technique, okay? So in this technique, your data is split. And actually, how you split can vary from technique to technique. There are different ways to do that. But in the most basic case, you split it into two parts. And you'll say one part will be the part on which I learn. Okay? This is where this machine learning comes in. So I will try to optimize my model. I will try to do whatever I decide to do. For example, to fit this part the best I can. The other part is put aside. We don't touch it at all. Okay? So, and we say this is the one that we are going to use to evaluate the goodness of our model. But when we do this, this goodness that we evaluate is not the goodness of fit. It's the goodness of prediction. Because that part has never been used in any way in the construction of our prediction rule. Okay? So this is this simulated prediction approach. And this is the only valid approach that we know that can be used to evaluate predictions. Short from actually making a prediction and then waiting, collecting more data later on and evaluating it on the new data. That's not very practical, right? At least not if you want to advance your academic career. So why is this an important discussion? Well, because when you, by the way, the first part that you learn from is called the training part, and the other part that you use for the evaluation is called the testing part, okay? It's really up to us. We are not restricted in any way what we're allowed to do with the training data, okay? And a common approach towards dealing with unbalanced data sets is to adjust artificially the balance of the training. So when we evaluate our data on the testing, we really should always be evaluating it on what we expect this real life to be. So we don't have any real play. Well, you'll see there is a little bit of that in this paper, but we don't have any real play as far as the testing part is concerned. So that's our representation of real life. We cannot fool around with that. But training is entirely up to us, right? This is our tool, and we can use it any way we want, okay? So what do we want to do in this case? Well, what people typically do, they either oversample the low probability class, or they undersample the high probability class, okay? Now, which one is preferable? Well, if you can afford it, undersampling is better. Why? Because when you do undersampling, you don't invent new observations. So when you do oversampling, you have to create more observations of the rare class, right? How can you create them? Well, you can just repeat them, but most learning algorithms will just ignore it. So if you have multiple copies of the same thing, it will be really treated as a single copy. So if you do that, it's not going to really help you, right, in many cases. So you can introduce small perturbations and claim that those should be still representatives of such a class. This starts getting shaky, okay? Well, you all know what sampling is, right? Okay, do you understand what undersampling or oversampling is? So you put aside a part for training. Undersampling means that you just randomly keep a part of the bigger class, right? Oversampling means that you have to increase the size of the smaller class by generating new observations. Yes, well, and the question is how. One way is you just create multiple quantities of the same observation, right? Okay, so since Michael asked, so you have this training part, right? There is, say, in this case, let's work with this concept. There are fraudulent observations and non-fraudulent observations, right? And with a huge disparity, right? Basically, it can very typical to have one fraudulent one for every 100 of non-fraudulent ones, right? So this is what we're talking about. Now, what you can do, what you're in control with, is the ratio of the fraudulent to non-fraudulent observations in this sample. Okay. By the way, Michael, I assume everybody has read the paper, so hopefully, what? I would say that the first paper is a difficult paper to follow. The second paper is not a difficult paper to follow if you trust them about their kernel. So if you decide that, okay, so whatever, but I'll grant that. So the first paper is a very convoluted paper, where, you know, what? Okay. So, no, the problem is that, I mean, Denise, you should know. So I think, and Paul, so we actually have two representatives here who have already lived through my machine learning class.
So I think in the undersample case, so let's say you had, like in this paper, we have fraud and non-fraud cases, so you have two classes. And the fraud class is clearly the underrepresented class where there are fewer records. So let's say in the non-fraud class we had 10,000 records, and in the fraud class we had 1,000. Okay? Disregard the splitting and training of test sets. What you would do is create a, through undersample, create a balance set whereby you have 1,000 fraud cases, and then you take a random sample of 1,000 of the 10,000 non-fraud cases. Now you have a balance set for use in machine learning. That's, I think, in oversampling, you go the other direction. So you then create 10,000 records of fraud cases. You have to create 9,000 new records, and then you have 10,000 of each class. That would be oversampling, right?
Very good. And yeah, yes.
Why does it have to be balanced sample?
Well, first of all, it doesn't. Well, many machine learning algorithms work best with a balanced sample. So when you have equal representation, because you know when you are dealing with predictions, so we see those labels, fraud and non-fraud. They're meaningful to us. To a machine learning algorithm, it's just zeros and ones. So they don't really make a distinction. You can swap the classes, you know, change the labels, and the algorithms will work in exactly the same way. What? Okay. Did everybody study in your elementary statistics course Fisher's discriminant analysis? You have never heard of this. Optimal separating hyperplane, where you have two classes, each normally distributed. The simplest case is the common covariance matrix, when the optimal separating hyperplane happens to be linear, right? If the covariance matrices are different, that you have a quadratic. What? What, you don't know it either? Oh, come on, please. Discriminant analysis? Okay. Okay. Look, you know what a multidimensional space is, right? So our observations are represented as points or vectors in a multidimensional space. If it is n-dimensional, that it means that there are n components, right? So imagine that you assume that you observe a data set which is in fact a mixture of two, right? And each one is normally distributed with different means, and let's say common covariance matrix. The covariance matrix is the matrix of covariances and correlation coefficients between the variables. You know what? Do you know what a covariance matrix is? Michael, do you know what a covariance matrix is? Okay. So you can visualize it as, say, this multidimensional space, and you have this aggregation of points here and aggregation of points here, right? you want to create a surface that separates one class from the other in this multi-dimensional space. Well, it looks like a distribution, but you know, this distribution, say if it is normal, right? It is much denser around the mean, right? So if you look at the multi-dimensional normal distribution, that you see the vector of the means, and those points will have much higher density around the mean. And then when you get farther and farther away from the mean, those points become sparser and sparser, right? So you have those dense areas, which are hopefully well separated. So we assume that they have different means, right? And those means typically are very easy, it's not a difficult problem to estimate where they are, but there is this procedure that allows us to determine what the optimum separating surface is, okay? And you can show it's a fairly simple exercise in basic statistics. You can calculate it. So in the case of, yes, Denis? In the case of, I don't have time to go into that. So in the case of normally distributed populations with the common covariance matrix, you can prove that it is actually a linear separating hyperplane. Basically, the midpoint between the two means, orthogonal to them, okay? And this is an optimal result. And you can show, it's a little bit more involved to show that actually if they have different covariance matrices, those two populations, then still the surface is rather simple, okay? It's a quadratic surface, okay? Basically, you have to invert this covariance matrix to calculate it, but it's no big deal. So this is a classical, say, machine learning algorithm, if you wish. So you are given the set with two classes, right? You know one, you know the other. In this set, you can calculate, right, what this optimal surface is. No, it's a different technique. It's not linear regression. It's a separation between the two, because this surface will be used to identify the class of a future observation, whether it is on one side of the surface or on the other side of the surface. The assumptions are very different, Michael. Don't confuse this, because in regression we mostly make the assumptions about the error term, right? So that's the only thing that really has to be normally distributed. We also have to make some assumptions about regressors, but again, and regression the output is a numeric value. Here the output is the class, one of the two values, plus or minus 0 or 1. Which we assign arbitrarily. The label is up to us. So it is a discrete choice model. It is not a numerical output. It's a different creature, okay? But my point was that, again, let me get back to this, because we have to get somewhere. So well, logistic regression is a binary choice model. Logistic regression is not linear regression. So don't confuse the two. It's not, no, he doesn't compare anything to linear regression. He compares it to logistic regression, which is a completely different ballgame, okay? Okay, so we control the training set. So what this guy does in this paper, he undersamples non-fraudulent companies in the training set. Yes. So there are other machine learning algorithms, and we'll talk about here. You know what? I'll have a slide where he lists 6. No, machine learning consists of many different algorithms, and this hyperplane is one of them. So calculating this hyperplane, this is called linear discriminant analysis. Well, linear when it is this, under this assumption, which is typically used in machine learning. This is one of many the quote-unquote machine learning algorithms. Yes, but using different means. Yeah, right. Completely different. And in many cases, you will see that what you are doing, say, it can be piecewise linear. So, for example, the surface that you will build to separate the two will be piecewise linear. Or it can be highly nonlinear, okay? And we don't even understand the nature of that nonlinearity, okay? Or it can be highly nonlinear, but it happens to be linear in some other space that we construct based on the original attributes. There are zillions of different methods. Well, because originally people designed those methods to make machines learn. Okay? You use all the data to learn something about the new data. Okay? So that's why, by the way, there are zillions of different names for this area. Machine learning is one of them. Data mining is another one which actually emphasizes larger size data sets, which is more in line with what people call today big data. There was a different area where pretty much the same methods was used by engineers in highly specialized areas. That one was called pattern recognition. So if you have heard about that, so there are even journals of pattern recognition. So artificial neural networks are usually considered to be a part of machine learning, quote unquote. But, well, an expert system is the reasoning part is not machine learning. So when you infer the rule base of the expert system, that is a machine learning task, right? But the reasoning part is not. That's just an inference. That's just an inference engine. Okay, so there are many different methods, but all of them use training to construct our prediction rule, okay? And what he does in this paper, he says, listen, I can control the ratio of fraud to non-fraud on the training, okay? So let me see what I can do with this, okay? And this is one of the important things that he investigates, because it is up to him. Yes? Nobody wants to deal with them because their the rules are very different, so that their financial statements are very different. So whenever you look at all these papers, it's very typical. Starting, I believe, with the, by the way, yeah, but it's better to deal with them separately. Yeah, because, you know, they are so different that you probably will just confuse your prediction rules when you are throwing in. Their financial statements have very different structure, right? So what is the significance of inventory in a financial services organization, right? Or cost of goods sold. That's another great thing, right? Yeah. Okay, so we're already on slide number 4. That's terrific. I have 52. Okay. So another thing that he does is this variation in how he evaluates the results. Okay. He uses something called ERC, estimated relative cost of misclassification, okay, which I will define on a later slide. And he defines later, right? What is important here in this slide, so to know that when he calculates it, he uses several different ratios of fraud, of fraudulent firms, and several different probability, several different ratios of cost, okay? Of false positives to false negatives, okay? So what does he use? He uses 3 different probabilities of fraud because he doesn't know exactly what the actual probability of fraud in the population is. Okay? He cites a number of sources that seem to have this consensus that the probability of fraud in the population is 0.6%. Okay? Yes, financial statement fraud is 0.6%. So therefore, he says that when he calculates the misclassification costs for his prediction algorithms, he will use it for 3 different ratios. He will use 0.6, he will use half of it, which is 0.3, and he will use the double of it, which is 1.2. Okay? So he will use 3 different ratios. As far as the costs are concerned, he will actually use 11 different options. And again, this is the ratio of false positive to false negative. So the misclassification cost. So what is the misclassification cost? At one extreme, he will use 1 to 1. At the other extreme, he will use 1 to 100, meaning that a false negative is 100 times more expensive than a false positive. And he will use 1 to 10, 1 to 20, 1 to 30, blah, 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 1 to 90. Okay? Now, those things are just the parameters that he throws into the calculation of the misclassification cost. They don't really change anything on the testing. The testing set is whatever it is. So he will get his prediction algorithms, he will run them on whatever testing he has, he will determine what is the false positive, what is a non-fraudulent observation identified as fraudulent, and what is a false negative, which is a fraudulent observation identified as non-fraudulent. And after he knows this, when he calculates the cost, the total cost, when he puts these things together, he will use those 3 different, he will use corrections for the 3 different ratios of the probability of fraudulent observations in the population, and considers 11 different cost ratios. Okay? So from this point of view, you see this table where he compares some significant prior research. He actually omits some important things. For example, that you'll see one of the key papers that the other paper cites was published in 2009 that he doesn't cite in this paper, even though this one is published in 2011. Okay, so again, interesting. But okay, so those are important papers. They bring in typically some fancy, popular machine learning methods that were considered, sexy at one time or another. And he looks at what they do. So what they do in terms of the ratio of fraudulent to non-fraudulent firms, and ratio of false positive to false negative costs. This is that's unbalanced. Well, it's very simple. Just look at this. It's all explained here. The guys that this paper you're talking say the first one, right? Green and Choi, artificial neural networks and random guessing. 86 fraud cases and 86 non-fraud cases. They just used a matched sample. No, they didn't collect it in the first place. Well, the way that this thing works, so it's difficult to collect fraud information. So everybody starts by collecting those fraudulent cases. So after they have fraudulent cases, they have to decide what to throw in, what kind of quote-unquote non-fraudulent observations to throw in. I say quote unquote because we don't really know that they are non-fraudulent, right? Correct. So there is this presumption of innocence, right? It doesn't mean that that guy is not a crook, right? He may be. It just has not been proven in the court of law. So again, I think that this evaluation is pretty generous. Because look at this. This says realistic. Well, come on, this is 32 versus 90. I mean, it's not particularly realistic. So basically, what this table shows is the following: that very few studies even attempt to deal with the problem of extreme unbalance in the sample. Now, many of them even ignore the differences in the cost. Pretty much nobody manipulates the ratio of fraudulent to non-fraudulent in the training sample. Okay? And in many cases, they don't even attempt to optimize their prediction rule. Okay? So let me dwell a little bit on this last point. Again, it would be easier to explain if you were familiar, say, with logistic regression, right? So what is logistic regression? Well, it's basically, do you know what a logistic function is? A logistic function is the function of y equals 1 divided by 1 plus e to the power minus ax, where a is the vector of the coefficients, x is the vector of variables. Okay? So this is a logistic function. Okay? Well, I mean, so basically, it looks like a smooth threshold function, right? So this is what a logistic function looks like, right? Are you with me? Okay. Now, so when people estimate a logistic regression, so they do this transformation of this function. They calculate the coefficients. But then they have to make, so they get this value of the logistic function, right? Which is going to be between a 0 and a 1. Okay? So they have to make a prediction about the class. And they assume that the low values are associated with one class and the high values are associated with the other class, right? But where do we draw the cutoff? So it is typical to draw the cutoff at 0.5. Okay? So you split it in half. So whatever is below 0.5 is considered to be 0. Whatever is above 0.5 is considered to be 1. But this cutoff is actually a parameter. Okay? So it doesn't have to be kept at 0.5. So you can see that maybe by shifting it up or down, you can achieve better classification results. So this is one of the examples. So when they're talking about this classification threshold. And you see here it says each one of them, optimal is not determined. Why? Because they use this machinery. They throw this in. Whatever it is, right? So they don't try. System typically doesn't do it, so they don't do it either. So the argument here is that all those previous studies are fairly deficient. And so here they summarize it, right? So they don't really try to do this, they don't try to do that, they try, and what the guy says, and I'm trying to do all of this now. Okay? So this is, of course, a very tall order. There is a good reason why those papers didn't do all that. Because it requires a tremendous amount of computation. So the work which is presented in this paper required a lot of number crunching. Moreover, that kind of number crunching cannot be done manually. You have to write scripts to automate it. Okay? So it requires a certain level of proficiency which may not be often present among the researchers who work in this area. Okay? Say in this area of applications. Of course, computer scientists have this. Okay, so what does he conclude from the analysis of that literature? Well, he says, well, look, neural networks have been popular, right? People love neural networks. Again, well, those of you who will take machine learning will learn what a neural network is, right? It's basically, originally, it was, again, a network of linear threshold elements with a hidden layer where you have all the connections from the input layer and then a combination to go into the output layer. Then it turned out that actually it's impossible to train such networks if you use the linear threshold element. And they were approximated using logistic elements. And then in mid-1980s, they invented something called backpropagation, which is basically a gradient descent method, again, a nonlinear optimization technique. Again, so you will learn, those of you who take machine learning, you will learn all this. So it was a very popular technique. People love to apply it to this area. One of the problems with neural networks, you create that architecture, you do this number crunching. It's a very flexible stochastic approximation tool. So you can change it now to adjust the coefficients to approximate a lot of different things. But convergence can be shaky. It's really impossible to tell how that number crunching is done, right? And it is often an extremely unstable technique, okay? So what they found here, yeah, those guys, they loved neural networks, and they seem to claim that, that dealing with those small balanced data sets and pretty much the same costs for false positive and false negative, those neural networks seem to outperform, right? What? What? Those guys considered both. Most of them considered both. They're not, I told you that it's not his conclusion. He says that in those studies, so what they observed, so when they dealt with the balanced data sets, right, the neural network seemed to be good.
What is the practical relevance of testing an algorithm against a balanced sum? When, of course, in the real world, it's not that. Well, what is it going to take away from it?
In my opinion, not much. The problem is, by the way, I don't know, maybe, again, I assume that it was clear to everybody. One of the biggest problems with extremely unbalanced data sets, if you don't take into account those differential costs, your solution is trivial. You see, if I have 1% fraudulent firms, and I'm evaluated on the accuracy of my prediction, I will be 99% accurate. You realize, right? I just say everything is non-fraudulent. It's a very accurate prediction. Well, unfortunately, when you work with many of those algorithms, this is exactly what they will calculate. Okay? So it's a very important problem to beat this trivial thing. For that, you really have people consider misclassification matrices where they actually list those false positives and false negatives and all that stuff. Whatever. There are some interesting early indications that that those guys who actually tried to work with some unbalanced data sets, or really tried to change the costs a little bit, they actually discovered that logistic regression actually was quite good. This is why, logistic regression is one of the oldest techniques that have been in existence, I would say at least 60, maybe 70 years in place. Okay, so it's a very, very old technique. And surprise, surprise, this old technique, which has not been considered sexy for a very long time, somehow manages to do pretty well, right, without much sophistication. That's one of the interesting findings. So what he does in this study, okay. So he compares several classification algorithms, okay? He takes into account both the imbalance of the data set and differential costs, and he evaluates how to manipulate best the balance of the training to achieve the best prediction results.